Welcome to the Deep Dive, where we sift through the noise to bring you the clearest insights from the market's most compelling stories. Today, we're taking a really close look at the Hackett Group's Q2 2025 earnings call, a period that, well, it screams company in transition. It's a high-stakes gamble they're making, pivoting aggressively into an AI-powered future. The big question we're tackling for you today: is Wall Street buying this bold new narrative, or are investors still waiting for the earnings to truly catch up with the vision?
It's a fantastic lens, really, to view a company at such a pivotal moment. We're seeing management fully commit to this Gen AI transformation, but they're also dealing with the immediate operational complexities and, crucially, the market's evolving expectations. We'll unpack where they excelled, where the numbers fell short of some expectations, and what management is signaling for the road ahead. This deep dive should really reveal the fascinating dance between that strategic ambition and, investor scrutiny.
Okay, let's jump straight into the headline numbers for Q2 2025, because they tell a story of stark contrast, don't they? The Hackett Group reported their GAAP EPS, that's generally accepted accounting principles earnings per share, the standard measure at just 6 cents, which is a pretty significant drop from 31 cents a year ago. But here's where it gets interesting. Their non-GAAP, or adjusted, EPS landed at a much healthier 38 cents, and that actually hit the midpoint of their own guidance.
Yeah, that distinction between GAAP and non-GAAP is absolutely crucial here. It's the first big signal, really. Non-GAAP often strips out those one-time charges or non-cash items, giving maybe a clearer picture of the core operational performance. The fact that adjusted EPS hit their guidance suggests the underlying business is performing, as expected by management, despite that headline GAAP figure looking quite alarming at first glance.
So a tale of two EPS numbers. Okay, how did revenue fare then?
On the top line, total revenue came in strong at $78.9 million. More specifically, revenue before reimbursements, which is typically the focus for analysts, that was $77.6 million. Now, this marks a modest, but I think important 2% increase year over year. What really stood out here, though, is that this figure actually landed above the high end of their guidance range. That's a definite positive sign on the revenue front.
And when we match those numbers against what analysts were expecting, we see that mixed picture continue, right? While that adjusted EPS missed analyst consensus by about, 9.5% estimates, were closer to 42 cents, the revenue figure actually beat estimates by roughly 3.1%. Analysts were expecting around $76.5 million, so they delivered more than anticipated there.
Right. This creates a fascinating divergence. A revenue beat is always welcome news, demonstrates demand for their services. However, the miss on adjusted EPS against consensus, especially when coupled with that dramatic GAAP EPS drop, it flags some underlying complexities that the market was clearly scrutinizing. Delving into the profitability side, their adjusted gross margin showed some strength, climbing to 42.8% from 42.3% in the prior year. Adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, stood at $16.1 million. That represents a pretty healthy 20.7% margin. So operationally, they maintained decent efficiency.
That is a good margin, but you mentioned the significant GAAP EPS hit. What exactly was behind that? Was it an operational stumble or something else entirely?
That's a critical question. A substantial factor was a 25 cent size per share impact from non-cash compensation and acquisition-related items. This was primarily tied to the purchase consideration for LeewayHertz, which they acquired last year. It involved service vesting requirements that, under GAAP accounting rules, are treated as compensation expense. So it wasn't really an operational miss in their core consulting work, but rather an accounting consequence of a strategic acquisition. It's almost like they paid a big fee up front, in accounting terms anyway, for a new, valuable tool.
Okay, so more of an accounting nuance than a direct operational shortfall, a crucial distinction for investors, I imagine. But these strategic acquisitions still cost money. How did they manage their overall capital and shareholder returns during this quarter?
Yeah, despite these strategic investments and the accounting impacts, they continue to manage their capital actively. The company reported $10.1 million in cash on hand and had $23.0 million drawn on their credit facility. They also remained committed to returning capital to shareholders, repurchasing 180,000 shares for $4.4 million at an average price of $24.50 per share. And post-quarter, they further signaled confidence by increasing their share repurchase authorization to $30 million, alongside declaring a quarterly dividend of 12 cents. So while earnings had some let's say, noise, they were actively supporting their stock and shareholders.
Okay, that sets the stage with the raw numbers. And let's really unpack this, because beyond those figures, management is clearly telegraphing a massive strategic shift. This is where the plot truly thickens. What's genuinely driving Hackett's strategy right now, and how are they translating that ambitious vision into, tangible operations?
It's exactly. Management emphasized a rapid pace of innovation, and you really feel it. Their big play is the accelerated launch of AI XPLR V4. This isn't just an incremental software update, it's a platform designed to create agentic workflows. Essentially, autonomous AI systems that can perform complex tasks and make decisions across clients' existing tech stacks. The core insight here, I think, is Hackett's bet that their deep, proprietary consulting IP embedded into these AI platforms can create a unique competitive moat. They're not just offering generic AI tools, they're aiming for faster, more tailored, and ultimately more effective solutions that others simply can't replicate out of the box. The goal's clear: to attract clients and channel partners by offering something truly differentiated.
And they're not just relying on internal development, are they? I mean, beyond building out their own tech, what other strategic levers are they pulling to accelerate this AI shift? Are partnerships playing a significant role here?
Absolutely. They've forged a significant new strategic alliance with Celonis, a recognized leader in process intelligence software. This AI plus PI, that's process intelligence combination, is a strong strategic move. This partnership is expected to significantly expand their market reach by integrating Celonis's insights directly into Hackett's AI XPLR and their ZBrain platforms. The aim is to accelerate the design and building of high ROI AI solutions with unmatched speed, accelerating value realization for their clients. It's about combining intelligent automation with deep process understanding.
So these Gen AI platforms, AI, XPLR, and ZBrain, they're being positioned as the core growth engines for the company. And it sounds like this isn't just about offering new products, it's fundamentally reshaping the economics of their business model.
Precisely. Management specifically noted that Gen AI engagements are demanding higher margins than their traditional consulting work. This is a critical point because it suggests a path to improved profitability as they scale these new offerings. This strategic shift is heavily supported by their recent acquisitions. LeewayHertz, acquired back in September 2024, brought in crucial AI delivery capabilities and that ZBrain platform. And the Spend Matters acquisition in May 2025 expanded their procurement market intelligence, further enhancing their ability to offer integrated, high-value solutions. While both acquisitions contributed to those GAAP-impacting expenses we discussed, they are clearly central to this forward-looking strategy.
It sounds like the strategic pivot is the overriding focus for the entire company, and it's impacting their various segments in different ways. Is this a uniform story across the board, or?
It absolutely isn't a uniform story, and that's important to note. For instance, their global SMBT segment, that small and medium business transformation, showed genuinely strong performance, up 5% overall. And when you strip out the temporary weakness from their one-stream practice, that segment was actually up an impressive 10%. Crucially, the Gen AI engagements within this segment favorably impacted gross margin, further underscoring the profitability we just discussed and the segment's successful embrace of AI.
Okay, that's a clear win for Gen AI adoption. But if SMBT is up, where did they face headwinds then?
That's right. In contrast, the Oracle Solutions segment decreased by 7.5% year over year. This was largely due to the winding down of a significant post-go-live engagement. This particular headwind is actually expected to be even more pronounced in Q3, simply because of a tough prior year comparison. However, on a more positive note, their SAP Solutions segment saw an increase of 11% year over year, driven by implementation services linked to prior software sales activity, a momentum they expect to continue. So yeah, a real mixed bag depending on the client base and technology focus.
It's good to know they have some stabilizing elements, though. Do they have a recurring revenue base that provides some predictability as they navigate these shifts?
They certainly do. A consistent approximately 21% of their revenue before reimbursements is recurring. This comes from multi-year and subscription-based contracts, which provides a valuable stabilizing element to their business model. It's like a consistent baseline, that helps cushion them through these transformative periods.
And this Gen AI vision isn't just about launching new products. It's about reshaping the entire organization, even leading to structural changes within the company. It almost feels like they're trying to perform open-heart surgery on their business while still running a marathon. A bold move, to say the least.
That's a perfect analogy, actually. Management clearly views Gen AI-enabled transformation as a generational opportunity, something that will fundamentally alter not just how companies operate, but also how consulting services are delivered. They see this as a chance to redefine their service offering and, importantly, their competitive positioning for the next decade.
And this AI XPLR V4 sounds like it's absolutely central to that transformation. What specifically makes it such a critical differentiator in what's becoming a very, very crowded AI market?
Well, what sets AI XPLR V4 apart, according to them, is that it leverages proprietary solution language models and Hackett's own deep intellectual property. This allows them to significantly accelerate the identification and design of those agentic solutions we mentioned earlier. But here's the really unique part. It's built with the ability to natively consider a client's specific enterprise application ecosystem. This means it can rapidly identify and custom design AI use cases that fit seamlessly into a company's existing systems, offering a significant competitive advantage. They can help clients understand precisely where existing automation ends, and Gen AI can extend to create truly meaningful performance improvements, not just, theoretical ones.
So it's not just about finding opportunities, but rapidly deploying tailored solutions. And to enable this, it sounds like they're not shying away from making some tough internal changes either.
They absolutely are. To align their workforce with this pivot and reflect anticipated productivity improvements from their Gen AI delivery platforms, the company anticipates restructuring charges, around $1.5 million to $2 million in Q3. These charges are primarily for severance costs as they reduce staff in non-AI practices. It's a deliberate move to streamline operations, reallocate resources to higher value AI areas, and make their workforce more agile and, AI-focused.
And where are their clients most eager to apply this Gen AI capability? What are the hotspots they're seeing for deployment?
They cited specific client applications for Gen AI across several high-impact areas. These include enhancing customer service, proactively addressing customer attrition, optimizing revenue management, boosting sales effectiveness, and significantly improving global business services, or GBS, organizations essentially, how companies manage shared services across departments like HR, finance, and IT. They were seeing a strong pipeline and early wins across these critical functions.
It sounds like they're building something genuinely differentiated. Have they received any strong external validation, any signals that their platform is truly standing out in a crowded market?
They certainly have. Management shared some excellent feedback on their AI XPLR platform from a senior person at a leading AI enterprise software company. This individual reportedly said they had not seen anything as complete and thoughtful as our platform. No, that's pretty high praise indeed, and speaks to the potential differentiation of their offerings in what can feel like a very crowded and noisy AI landscape.
Okay, so management is clearly bullish on this Gen AI transformation, making bold strategic moves and backing it up with internal restructuring and strong client feedback. But what was the immediate market response to these announcements and figures? Did investors share management's enthusiasm?
Well, the immediate market reaction was quite telling, and it suggests a healthy dose of skepticism, maybe. The stock price dropped by over 9%, or $2.06, from its pre-call close of $22.78 to $20.72 the very next day. And this move was accompanied by a significant spike in trading volume, from roughly 0.34 million shares to about 1.14 million. This suggests a notable shift in sentiment, a collective wait-and-see from the market, perhaps.
Yeah, that market reaction isn't what you typically see with a revenue beat and such strong strategic messaging about an AI pivot. What does that divergence tell us?
It definitely points to a neutral to cautious sentiment prevailing. While the revenue beat was acknowledged as a positive, the EPS miss against some estimates, and critically the softer Q3 guidance, seemed to temper enthusiasm for the strategic narrative. The core insight from this market reaction is clear. Investors are signaling, show us the money, not just the strategy. Right. They're looking for tangible earnings leverage from these AI investments, and they want to see it now, not just hear about future potential. It's the classic tension between long-term vision and short-term financial results.
And this Q2 performance isn't really in isolation, is it? How does it fit into the broader picture for the stock? Has the market been this skeptical for a while?
You're right, this isn't a new phenomenon. This Q2 performance comes in the context of longer-term challenges for the stock. Trailing total returns show approximately negative 15% over the last 3 months and negative 19% over the last year. This contrasts sharply with the positive performance from broader market benchmarks like the SPY and the tech-heavy XLK over the same periods. So the market has been applying pressure for some time, looking for a clear catalyst to re-rate the stock upwards.
And what about the outlook? What's their guidance for Q3 telling us? Is the market anticipating this digestion period to continue?
The Q3 guidance certainly implies that. They're projecting revenue before reimbursements to be between $73.0 million and $74.5 million. with adjusted EPS expected to land between $7.36 and 38 cents. This essentially signals a near-term period of ongoing integration costs, continued investment in their Gen AI programs, and a maturation of sales cycles for these newer offerings. The market, in turn, is pricing in this digestion period, indicating they don't expect an immediate earnings pop from the AI push.
So it's really about translating that innovation into tangible financial results and overcoming this near-term digestion. What should investors be looking for in the coming quarters to see if this strategic bet truly pays off? What are the key catalysts?
Yeah, key catalysts for the coming quarters will be watching for incremental AI XPLR releases and, crucially, significant reference wins with named clients that showcase the platform's impact. We'll also be looking for successful cross-selling efforts with Spend Matters, any significant ramps in SAP or Oracle implementations, and updates on their capital return strategy. Ultimately, management's credibility hinges on demonstrating that AI, XPLR, ZBrain, and the insights from Spend Matters actually shorten time to value for clients and significantly lift attach rates and recurring revenue mix, driving meaningful margin expansion.
So it's not just about building great tech, but proving that it drives the bottom line.
Precisely. While the broader industry backdrop of resilient enterprise tech budgets and widespread AI experimentation is supportive, demand for advisory and implementation services remains selective. Investors will be closely watching the trajectory of EPS to catch up with the revenue narrative and ultimately validate management's bold strategic pivot. It's a critical period for them, no doubt.
All right, now for This Is Not Financial Advice segment, where we put on our most speculative analyst hats and pitch an outrageous but plausible trade idea for the Hackett Group. Remember, this is purely for entertainment and conceptual exploration, so buckle up.
Okay, given the market's roughly 9% reaction to Q2, combined with management's aggressive AI pivot and the strategic restructuring, my trade idea for you is the AI-fueled margin expansion arbitrage.
Intriguing. Okay, lay out the premise for us. Why is this outrageous yet plausible?
The premise is this. The market, I believe, is maybe myopically punishing Hackett for near-term EPS softness in Q3 guidance that clearly signals ongoing investment and restructuring. However, management is actively cleaning house with those Q3 restructuring charges, primarily severance related to Gen AI productivity improvements in non-AI practices. This isn't just cost-cutting. It's a deliberate, forward-looking move to streamline operations and reallocate resources to higher-value, higher-margin areas. The outrageous part is betting that the market is significantly underestimating the future margin leverage and recurring revenue potential from AI XPLR V4 and the Celonis partnership. The company already explicitly stated that Gen AI engagements demand higher margins. This isn't just a simple pivot. It's a fundamental shift in their business model towards a future of higher-value, platform-enabled services that could radically change their profitability profile over time.
So you're basically saying the market is short-sighted, focusing on the pain of transformation rather than the potential gain. What would be the specific play here?
Exactly. My outrageous but plausible trade idea would be a long-term synthetic long position. This expresses strong conviction in a significant price recovery beyond its current levels, betting on the AI platform's earnings leverage to eventually materialize. You could consider purchasing 8 CKT call options with an expiry way out, maybe late 2026 or early 2027, with a strike price around $25. Simultaneously, you'd sell out-of-the-money put options with the same expiry and a strike price maybe around $18. This strategy allows you to express a strong bullish view over a longer horizon, anticipating that the underlying value of their AI platforms will eventually be recognized. The market is pricing in near-term digestion, but not, in my view, the potential explosion of recurring higher-margin AI licensing and platform revenue down the road. Plus, that increased buyback authorization also provides a potential floor and a signal of confidence from the board, offering a bit of downside protection while you wait for the long-term strategic transformation to override this short-term noise.
So, the Hackett Group's Q2 2025 earnings present a truly fascinating study. A company right in the thick of a bold Gen AI transformation, demonstrating revenue strength and strategic innovation, yet facing immediate market skepticism over whether that will translate into clear earnings leverage and overcome near-term headwinds.
Absolutely. While management is clearly committed to their Gen AI vision with platforms like AI XPLR V4 and strategic alliances, the market is signaling that it wants to see tangible evidence of this pivot translating into consistent EPS growth and sustainably improved margins. The coming quarters will be critical, absolutely critical, in demonstrating if their strategic investments in AI can truly differentiate them and deliver the expected shareholder value.
A crucial period indeed for a company making such a big bet on the future of AI and enterprise consulting. Remember, the information discussed in this deep dive is for informational purposes only and is definitely not financial advice.
Always do your own research.
Thank you for joining us for this deep dive into the Hackett Group. We hope you gained valuable insights to inform your own thinking. And as we watch Hackett navigate this pivotal moment, it kind of leaves us with a question. In the race for AI dominance, is it better to be first with a bold vision or patient for clearer profitability? Something to chew on until our next deep dive.